are reacting today to President-elect Trump's new tariff plans. He stated in a social media post last evening that he would impose an additional 10% tariffs on China, and 25% tariff on each Mexico and Canada. This news comes as markets continue reaching all-time highs, including small caps. So is there room for small caps to continue growing? We might ask that of the large caps as well. For a look at all of this, joining us here today for a look at the global markets and the different cap sizes within the global markets, and for an update on Fidelity Global Intrinsic Value Class is Institutional Portfolio Manager Naveed Rahman. Hi, Naveed. Great to see you.
Hi, Pamela. Nice to see you as well.
Yeah, delighted to have this chance to speak with you, and everyone else who's joining you here today can go ahead and send in questions here. Naveed will answer as many of those as he can. So we do know there's lots of discussion about tariffs. Can't really get away from it in a way. It just seems to be increasing. It's a big trade story. Trade is macro. I wonder if you might just discuss sort of the macro facts on the ground as you know it right now, and to what extent you're following those to help with your investments.
Sure. First of all, the portfolio is built bottom up. So we think about the macro, but it is not the overwhelming driver. It is really the bottom up stock by stock analysis. But having said that, Pamela, I think oftentimes the adage that like the market rhymes but doesn't repeat itself is worth mentioning here, because this is President-elect Trump's second time being elected. And so the market expects many of the same things, and he's talked about that. But at the same time, the facts on the ground are not exactly the same.
Right.
Interest rates are substantially higher already today than they were in 2016. The size of the U.S. deficit and the U.S. debt as percentage of GDP is substantially higher. And maybe one other thing I'll think about is that tax cuts were a big feature of the first administration. They are set to expire. So, sort of the default assumption is that actually personal income tax could actually go up in the U.S. unless Congress acts to extend those cuts. So on all those dimensions, things are a little bit different. So the trajectory of actions or events, might seem similar, but I think the market may react to them differently. And maybe the last point I'll say is that the market has almost front run some of the expected results there. So with the small caps, banks, financials, etc.
Okay, well let's dig into that. So the market front running certain other sectors or particular plays, and then you come in very much with sort of a bottoms up approach. But if we just talk about the success of the Magnificent Seven, really the biggest cap companies in the market through this year. We've also seen a broadening out. We know about that. I want to ask you about that. But that is also quite different, isn't it, this time around? I mean, just the amount of power some of those companies, massive companies, have right at the very top.
Oh, absolutely. And it's almost like staring us right in the face. So it's hard to recognize how immaterially different it is. So I think we were looking at the numbers on our team just earlier this week. The 5 biggest companies in the U.S. account for over a quarter of the market cap of the entire equity market. Right, 10 years ago, those companies accounted for 10% of the total market. So they are much bigger. They have delivered exceptional growth, but they've also become much more expensive. And I do think that we are in a point in time where global equity markets, but the U.S. market in particular, is more concentrated than has been in 4 decades. And that bears sort of keeping in mind, especially if we look out the next couple of years. The earnings growth forecast for some of these really large companies, the Magnificent Seven, as the market calls them, they're still delivering earnings growth, Pamela, but they are decelerating. And the rest of the market, to your broadening point, has projected earnings growth that's almost comparable to the Magnificent Seven.
Yeah, I was just going to add to there that gave us those numbers of what those companies were worth, 10% of the market X years ago. It speaks to the concentration, which, I mean, your fund for many, 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 many years has really made sure that it is not concentrated in that particular way. I mean, it's literally an antidote.
Yeah, well put. We are I don't want to say anti, but we're probably the absolute complement to a top-heavy growth tech-oriented market. We are a global small and mid-cap portfolio with regional valuations, high quality, and so more diversified across sectors, further down in cap, and more global versus U.S. centric. So on all those dimensions, much more complementary. Maybe the one thought I'll finish is that the rest of the market is catching up to the Magnificent Seven from an earnings growth expected perspective, but one place they're very different is valuations. The top biggest stocks are substantially more expensive than the rest of the market, 35% more expensive on forward earnings. So it's a really interesting time to be an active stock picker and to be able to sort of compare and contrast the opportunities in the marketplace. And again, harkening back to the theme, I think the markets will rhyme, but I don't think they'll repeat themselves. And the exact sectors and the exact cap that has led for so long, the expectation for them to continue to provide leadership, it's getting stretched.
It's getting stretched. And I mean, at the moment, we're sort of, I mean, I think making a little bit of an assumption that we're talking largely about the US in terms of cap sizes, opportunities, differences between one administration and another. But let's look more globally, because this fund is absolutely oriented to do that. When you look around the world, there are all kinds of things like currency issues with countries and companies that have to deal with a very strong US dollar. But that said, there probably are a lot of very cheap, quote, value stocks all over the place.
Absolutely. And I'll make 2 points on that question, Pamela. One is that when you invest primarily in small and mid-cap stocks, they are a little bit less sensitive to currencies because they tend to be champions in their domestic market. So a lot of the companies we are finding in Europe and Japan have some exposure to the dollar, but by and large sell into their large domestic markets. So they're insulated a little bit more than global sort of mega cap type companies, right? And then the second point is the valuations are just materially different. We own a number of tech companies in Japan that are in the electronic semiconductor related space. And it's remarkable. If I showed you the company in Japan, its earnings growth profile, its free cash flow generation, and then I asked you to guess its multiple, you would think, as Americans, we think like this has got to be a 25, 30, 35 PE stock because it's growing so well. It's in the AI sweet spot. But you find these companies in Japan at 15 times earnings.
Wow.
And it is remarkable that if I change the domicile of that company from Tokyo to Palo Alto, the multiple might jump. I mean, I'm exaggerating for effect here, but you get my drift. It is very similar companies with similar competitive advantages trade at material discounts in places like Japan and developed Europe.
So, okay, let's go to Europe for a second. Europe has been cheap. Some people argue for good reasons, but take us there also. Have things been overdone?
Yeah, absolutely. It's a fairly challenging macro backdrop for a European domestic-oriented company. Growth has certainly slowed and is less attractive there than it is in North America or in many parts of emerging Asia. And then there's the geopolitical risk. I mean, there's a war, in near proximity that is both risky on its own, but also has the impact of driving up, elevating energy costs for a place in the world which is a net energy importer. But those are all largely in the stocks. The valuations there are at historical lows. And again, I think the advantage for someone like us on the Fidelity Global Intrinsic Value portfolio is we don't have to own the entire European market. There are some very slow companies, that are resistant to change, not competitive on a global scale. But we find a number of pretty interesting companies in Europe, in the industrial space, within the auto supplier zone. That's the auto OEMs in Europe the original equipment manufacturers are in a very difficult spot and from a labor cost competition are not very competitive. But the auto suppliers, which are agnostic to the EV combustion engine transition, they're priced equally cheaply but offer more upside for us. So that's a place where we have a number of smaller risk controlled from a bet perspective. bets.
Something that ties together, I think Europe and Japan and Canada, um, is a company that is in a lot of these different spaces as well, and also gets brought up in the context of a transition to EVs is not one or the other necessarily an existential threat. This is a company that, yeah, I'll have you take us there, but they're in the midst of, it looks like, an M&A.
Absolutely, yeah. So yeah, we've owned Couche-Tard, a great Canadian company in the portfolio for a number of years. You know, excellent management team, very capital allocation has historically been a strong suit for the company. Um, they're a very efficient operator of fuel service centers around the world. And One of the bear theses on this company for the last couple of years was, as North America, Europe, and especially China have all moved towards EVs, does the fuel center business, come under threat? And our research tells us, and I think this is bearing out, that they're actually pivoting very nicely to a world that is more hybrid, EV plus combustion engines, and reorienting their service centers so that there are amenities and things for us to spend money on while we wait for the 30 minutes to charge our cars, if that's what we're doing. So that's one aspect that I think the market misinterpreted. I should mention that it's very public. Couche-Tard is in the process of trying to acquire us, the 7-Eleven convenience store business in Japan. Um, and I guess I'll say two things about that. The very fact that it's on the table is an indication that um, corporate sort of shareholder-friendly policies in Japan have improved over the last decade. This would probably not even be on the table, 10 years ago, because 7-Eleven is really considered a national kind of treasure in Japan. But it also speaks to the fact that acquiring prominent companies in Japan is not the same as doing that in Canada or the US or in the UK, for example. And there are hurdles to overcome. There are cross shareholdings and other issues that make it more complex. Um, we have no intelligence on whether this deal will go through or not, but I think from where we sit, there are potential benefits if the deal goes through for Couche-Tard, and then there is the benefit of like the hangover of this deal going away if it eventually gets blocked. So it's difficult to say where we sit, but we think that it's a good risk reward, and it really meets our criteria for high quality, reasonable valuation for growth.
Yeah, it's really fascinating, and it's a whole story that's painted really outside the question of TINA, U.S. exceptionalism. It's although they have assets in the U.S. as well, but it's just a really interesting sort of part of the global story, because the global story and the multinational story is getting a bit clobbered right now by the discussion of tariffs. So it's just sort of interesting to see light poked through. Are there more opportunities in that way?
Yeah, no, absolutely. And I think it's difficult to resist the temptation to not respond to sort of news flow about tariffs and appointments to the cabinet. I think one of the things I've learned as being an investor at Fidelity for more than a decade is that we should react to policy, not politics. And the politics is highly variable. It's sometimes gamesmanship, sometimes there's truth behind the rhetoric, hard to discern. But it is really the policy on the ground that one should respond to, and that's where Fidelity spends its resources. We try to understand, where there are meaningful changes in policy, and where the stocks are mispriced, according to sort of those issues. And maybe I'll pivot for a bit to financials. Like one of our, we have a large allocation to the financial sector, and one of our larger holdings in financials, is a company that has for the last 3 or 4 years been in the regulatory spotlight for transgressions in its past, 6, 7 years ago. And we saw through that, built the position because to your metaphor, Pamela, there was light at the end of the tunnel. The underlying business remained healthy. There was a new management team in place driving capital efficiencies and sort of a more stable operating environment for the company. And that has all sort of started to come to pass in the last 18 to 24 months. But as that's come to pass, the stock has outperformed materially. So where the opportunity was greatest and most compelling to us was before the dust had settled and before it had all cleared. And that's just a reminder that um, the way we invest is we do this work beforehand. We stress test, what we think these companies are worth. And then at the point of pain or at the point of debate, we usually step in and build a position. You don't do the work after you hear about the tariffs or after you hear about a regulatory scrutiny. You want to have done the work beforehand and then sort of step in a difficult situation when it's warranted.
When it's warranted. Well, let's pull up, actually, there's a couple of performance slides I think we'll share with people just to see. Again, you were saying you were avoiding using the word anti, but complementary, I think, to some of the mega growers over the last couple of years, and just sort of taking a look at the performance. Do you want to just take us through, like?
Yeah, absolutely. And we're really proud of the long-term performance of the strategy, and this page and the one after actually maybe even demonstrates it better. So I think I'll say two things about this. One, we've delivered strong performance without really the wind at our back, right? So it has been a decade plus growth market, as we've been discussing, mega cap, concentrated market. That's not a particularly favorable environment for us, but we have outrun those headwinds with good security selection. If we go to the next page behind that, another attribute of our performance is that when you invest in reasonably priced, high quality cash generative companies like we do, um, you naturally have a portfolio with a better risk profile than the market overall. So I think over the last 5 years, our upside capture is 85% and our downside capture is under 50% in an all equity portfolio. So where you're getting almost, 8.5% of every 10% up move in the market, but you're only capturing 5% of every 10% down move in the market. And you can see that in the calendar year results, right? So in a year like 2022, equities were down across the board. U.S. equities, Canadian equities, fixed income had a really rough patch. This portfolio hung in there really well. There are, companies that have the elements of a Couche-Tard scattered throughout our portfolio. They are highly cash generative. In a good year, their earnings might be up 15, 16, but in a bad year, their earnings are flat to up 3. And that's not impressive in a year like 2024, but it's extraordinarily impressive in a year like 22 or a year like, 2020, for example. So
Take us through, we started off with the macro, and you talked a bit about how that's not necessarily what you're looking at, because you're very much bottoms up in terms of your investment approach. But that said, companies had a very tough time sort of coming out of the pandemic. It was a rough go. Then we got into the inflation and the rates taking off as well. Just put some of that into perspective, because although some things can be left on the side, that was quite a cycle. Just tell us
yeah,
apropos on the result.
absolutely. And I think that this ours is a low turnover approach, generally speaking, but when the market gives you a big a big volatility event and everything reprices, we're very active, and we will sort of be nimble around our positioning. A more recent example of this is, we came into 2023 underweight financials. There was a sort of a really big period of stress in financials about 12, 15 months ago now, with several US financials going under. We avoided all of those with our risk controls and security selection acumen. But in times like that, Pamela, sort of the baby gets thrown out with the bathwater, and we spend the time to figure out, well, what are the high quality companies that are also down 30 or 40% along with the low quality companies, and let's scoop some of those up. And having flexibility to be overweight this sector when the opportunity presents itself and not being constrained by cap is also important. So we are generally small mid cap investors, but in US financials, that's one place where most of our exposure is mid cap and up. And that's because in the US, deposit share is increasingly getting concentrated in mid regionals and mega cap companies, which are better capitalized, can meet the regulatory hurdles better, and the small cap banks are comparably priced but losing market share. So that's a place where we were opportunistic. It kind of went up in cap when the opportunity presented itself. But it also speaks to sort of being nimble and taking advantage of the opportunity when it's there.
There's a question rolling in here, Naveed, about M&A, and you just wonder, as perhaps the prospects get better for small and mid cap, as you're just talking about now, do you expect before they perhaps really take off, if you think they will, to see an increase in M&A? This question is asking how might an increase in M&A impact small and mid caps? I mean, first, do you expect that? And yeah.
I think it has been a difficult M&A environment the last 4 years under the current administration. Some of the scrutiny is very valid, but there's probably some M&A that was a little bit more debatable when the scrutiny happened. I think as a general course, we do expect the incoming administration to have a lighter touch approach to M&A, but it's very case specific. The challenges that the mega cap tech companies are facing are not specific only to the US and are actually fairly bipartisan. So, the challenges, for example, we don't own most of the mega cap as in this portfolio as we discussed. But a company like Google is facing, material threats, not just from the U.S. Department of Justice, but also from the European Regulatory Commission, and from jurisdictions around the world. And it's these companies have gotten so big that their ability to acquire their way into growth is constrained kind of regardless of kind of the M&A environment. So I guess my nuanced answer is for companies that we invest in, this is probably a better M&A environment because they tend to be small and mid-cap companies that don't present as much of a monopoly threat. But for the mega cap tech companies, I think it's going to be a harder M&A environment, period, full stop.
Right. Really interesting. Yeah. The regulatory things that sort of come into that and come home to roost a little bit, it sounds like. Other parts of the world that you are interested in and perhaps are, companies exposed to their own domestic economy that maybe have less that sort of multinational question mark on tariffs. You mentioned Japan, you mentioned parts of Europe. Where else?
Yeah, I mean, probably if from the big perspective, those are the two areas that I would highlight the most. But I think from a sector perspective, um, industrials is a place we are continuing to take a hard look at. It's The industrial sector is a bit more heterogeneous and more of a hodgepodge. So there are quite a few different sub-industries there. We've done really well in the portfolio owning electrification related construction companies. They are benefiting sort of from the kind of the deglobalization of the supply chains around the world. So we've taken profits, exited those kinds of companies. I mentioned autos at the outset. It's a controversial sector. It's a really rich stock pickers environment, right? Because there are the original equipment manufacturers in the US, in Europe, are taking very different paths. And some paths we see as maybe a little bit of like head in the sand, not acknowledging kind of the competitive realities. And there are others, that where we see capital discipline, investing for the long term, and sort of not reacting to the short-term kind of news flow. And so we have, I think, one medium to medium-sized OEM position, and then the auto suppliers, broadly speaking, are just a really interesting part. They are trough valuations, trough earnings. So, that's the kind of thing where our big alpha generators in 2024 were mostly positions we built in 22 and 21. And so for me, I think some of these auto suppliers that we're building positions in now, may not like immediately pay out in rip roaring earnings in the first quarter of next year, what have you. But over a full cycle, as we look out 18 to 24 months, the earnings upside is tremendous. And then the possibility for a little bit of a lift in valuation is also there. So, that's a pretty interesting part of the market where we have repositioned within industrials.
Yeah, that's really interesting. And what it sort of means to be an industrial seems to be changing quite a lot. You mentioned
Fair enough. Yeah.
and that story, but it does seem to, is that for you more of a US story, investment story, or is that a bit more around the world?
Yeah, it's a bit of both. There are and I guess on that US topic, I should highlight that the portfolio's largest country allocation is the US, but that's a little misleading because it is also our largest underweight from an active perspective. So when we find opportunities, we certainly will invest in kind of our home market. But I think the example that I highlighted of sort of electronic component semiconductor company in Japan at 15 times, and literally we know it's two peer companies in the US, and they both trade at 35 times earnings. So there's just a really big, 15 times for 15% growth or 35 times for a 15% growth. Like it does seem like a no-brainer to be in those cases to be underweight the U.S. and overweight outside. But obviously, it's stock by stock specific, and we certainly own a handful of U.S. industrial companies. And U.S. tech companies, but again, they're very different from the glamour stocks with the heady valuations that most of our clients are very familiar with.
It's fascinating to get, this discussion in right now when it does seem like the smaller cap or the broadening story is so much at work. And in fact, you've been in it for some time, watching it for some time. And
Yeah, and I was remiss in saying, Pamela, when you asked about the M&A question, one of the advantages of our approach of buying reasonably priced cash generative companies is that strategic acquirers often find our companies very attractive. So, we have a large financial holding that is going to be that there was an announcement to acquire it earlier this year. I think last year we had probably a half dozen companies in our portfolio acquired by strategic buyers, people like Apollo or Blackstone, et cetera. And so that's not, I mean, we don't buy with the intention of hoping it gets bought out, but that is not a surprising outcome for us because if you think about it, someone like Apollo does not want to buy a low quality, cheap business because they can't lever that up and sell it back to the public markets. And they like to buy the kinds of businesses we own because there's underlying fundamental health in the company. It's probably an underlevered balance sheet. It's cash generative. So perhaps a strategic acquirer can buy that, improve the operations a little bit, put some debt on it, and then revalue the company for the sale. So I think we do benefit from the M&A directly as well, just by owning the kinds of companies that are typically the target of bigger companies or strategic acquirers.
So it'll be fascinating to catch up with you in time and see how many, if this is a rising M&A environment, how many have gone that route. Naveed Rahman, great to see you. Thank you for the catch up today.
You're welcome.